Hello, everybody, and welcome to another edition of the CBAR webinar series. I'm very happy to have you here. My name is Andreas Park. I'm a professor at the University of Toronto, and I'm your host for today. We're very happy to have two excellent speakers here who will be talking about crypto asset pricing. Just for some background, I think one of the big topics that comes up in the blockchain space is, how can we apply maybe knowledge that we have acquired over a century in evaluating financial assets, how we can apply this to crypto assets. And we figured this is a good opportunity to put a session together so that we can discuss some of the findings that we have seen in the academic space. Today we have two speakers. We have Jiaen Li from Washington University and in St. Louis, and we have Gordon Lee from Circle. We will have the way this session will be organized from a housekeeping perspective is we're going to start with Jiaen Li. She's going to talk for about 25 to 30 minutes. We're going to have that followed immediately with Q&A about a paper, and then we'll move on to Gordon. Now, you're welcome to put questions in the Q&A so that I can be able to see them. If I see that there is a need for clarification, I may interrupt the speaker. Otherwise, we're going to let Jen talk for 25 minutes nonstop. With that, let me again to introduce you to Jiaen Li. As I said, she's a PhD student at WashU. However, she will graduate very soon, and she has accepted a position at Florida State University in Tallahassee. So congratulations on that. And we're very happy to hear you talk. Jiaen, the floor is yours.
Let me share my screen. Okay. Yeah, thanks, Andreas, for the warm introduction, and thanks for having me here. So I'm happy to talk about this is my job market paper, Ideology and Asset Pricing. I study the role of ideological narratives in asset pricing as a source of systematic risk and using cryptocurrency as a natural laboratory. So first, why ideological narratives? Daniel Kahneman once said, no one ever made a decision because of a number. They need a story. Robert Shiller also highlights the importance of understanding how contagious narratives can affect economic behaviors. So here the focus zooms in on a specific kind of narratives, ideological narratives, narratives that convey ideological values. For example, Bitcoin and anarchism. So it's not a coincidence that Bitcoin was created during the financial crisis, and it seems to have great emotional appeal to people who are not satisfied with the government or authorities at the time. So early adopters of Bitcoin are often associated with the image of anarchists. In fact, Robert Shiller in his book Narrative Economics include a section with that exact title. It's used as a supreme example as how contagious, successful economic narratives can result in substantial economic changes. And indeed, cryptocurrencies provide a perfect and exciting opportunity to study the role of ideological narratives in asset prices. Crypto's rapid growth and extreme volatility have attracted attention and interest from investors, regulators, as well as researchers. There's a growing body of work on cryptocurrencies and also blockchain economy, and many in the audience have done great work and contributed to this line of literature. So cryptocurrencies are known for being extremely volatile and highly speculative, and its obscure nature, not having cash flows in the traditional sense like traditional assets, stocks or bonds, makes traditional asset pricing models fall short in explaining its price movements. So that leaves room for some new perspectives. For example, investors may rely more on emotions or animal spirits to make their decisions rather than fundamental analysis, rational analysis based on solid fundamentals. So that's what this paper is about. I study whether ideological narratives that convey ideological values, can help us understand what's going on in the crypto market and about crypto returns. So a little bit background on crypto ideologies. Cryptocurrencies is rooted in libertarianism. Various media outlets, whether it's mainstream like Wall Street Journal's, New York Times, or Financial Times, or more crypto-focused like CoinDesk, all relate cryptocurrencies to libertarianism, saying it's a libertarian project, or a bit negative or critical view saying it's the libertarian fantasies. Weber et al. 2023 also reports that crypto holders tend to be more libertarian than non-crypto holders. And when we look at libertarianism, there are two primary aspects. First, minimal government, and second, individual empowerment. And along the line of minimal government, we have anarchism, for the lack of better labeling. I'm just using this label based on various anecdotal accounts. For example, Bitcoin.org, the previous official website of Bitcoin, one of its co-founders was Satoshi Nakamoto, and dated in 2016, it carries a passage from an anarchist saying Bitcoin is the catalyst for peaceful anarchy. And also, not just Bitcoin, but the token ecosystem are also viewed as a wonderland for the crypto anarchist. And in my paper, what I'm really focusing on is that the distrust or dissatisfaction, some negative emotions against government control or authoritative power, is not as extreme as being anarchy. It would be more clear when I talk about measurements and also when you see specific examples. So the second aspect is individual empowerment, and in the crypto space is decentralization, the fundamental principle behind the whole ecosystem that engenders freedom and enables individual empowerment. So those are the two ideological narratives and values I'm gonna focus on. Before I take everything to data and run all the tests, let's think generally about how ideological narratives can affect asset prices. So ideological narratives have certain features that make them highly suited to going viral and being effective in influencing economic behaviors. First is value attachment. Bonobo and Terrell 2016 argues that psychological beliefs often fulfill certain important ideological beliefs often fulfill certain psychological needs, and people hold certain beliefs partly because of that value attachment. So through value attachment, investors may attach greater values to assets that are more aligned with their ideological values or ideological beliefs, leading to greater valuations and lower expected returns. So that creates some cross-sectional variation in average returns. Additionally, ideological narratives often foster a sense of shared identities by either appeal to some collective goals, for example, building towards decentralized world in crypto space. Also, they tend to include some us versus them element. The crypto community, especially on social media, is known for being tribalistic. And the blend of shared values and identities is emotionally stimulating, and that helps the story go viral and be contagious. And a widely spread narrative can shape collective beliefs. It could tie together investors' expectations across the market, leading the assets to move together and creating some systematic movements. So in sum, it suggests that ideological narratives can affect asset prices systematically. However, to the best of my knowledge, there's no quantitative evidence documenting the role of ideological narratives being a source of systematic risk in asset prices. And that's my paper comes in and fill the gap. So I find two ideology factors based on the anarchism and decentralization narratives. They are priced in the cross-section of crypto returns, and a two-factor model based on this anarchism and decentralization dynamics can explain the cross-section of crypto average returns better than pre-existing crypto factors like crypto market size and momentum. I measured the ideology dynamics using the social media data and with the help of large language models. And secondly, the ideology factors they can persistently predict future crypto market returns and user network growth up to 6 months ahead. So this suggests ideology factors, they're not just noise or some mispricing that accidentally capture the variation in the cross-section of crypto average returns, but they actually contain important information about the future crypto market. And finally, I find when there is an unexpected increase in ideology salience, we observe significant positive spread between more ideology-aligned cryptos versus less aligned ones. So that suggests when the collective attention to ideological narratives heightens, when these collective beliefs get reinforced, there is an increase in relative demand for more ideology-aligned cryptos versus less aligned ones. And overall, my paper provides novel quantitative evidence on the role of ideological narratives in asset pricing as a source of systematic risk. So my paper primarily contributes to the literature on narrative economics, first advanced by Robert Shiller, who calls for serious quantitative studies on how economic narratives that go viral can affect economic behaviors and result in substantial economic changes. And also it relates to social finance by David Hirschleifer, who suggests we should figure out more how stories that spread through from person to person can affect in the social network can affect economic outcomes. And also my paper is related to the growing literature on cryptocurrencies and the blockchain economy. There are many great works in this literature, and we'll see more in the future as what this forum is about. It's a very exciting new field. And because I'm using the text data as a measure, how I measure the ideology dynamics, so my paper is also related to the literature on using text as data. And finally, to the literature on the role of ideological values in economics and finance, most existing studies usually focus on political preferences that are, for example, Democrats versus Republicans. And my paper studies the role of ideological values that is libertarianism. So it's not falling on the typical dichotomy axis of right versus left. And going forward, let's talk about the data and also the empirical test. First things first is how I measure the ideology dynamics. I'm using the text data from social media. Specifically, I'm using X, previous Twitter, as the text source because X is the one of leading platform that crypto community choose to voice their opinions and broadcast news. The choice of the text source is important here because mainstream media often hold either critical or some relative suspicious view of the cryptocurrency space. So using newspapers from mainstream media may misrepresent the beliefs held by crypto investors. And specifically, the ideology measures reflect the volume of ideological messaging on social media. By that, I mean the number of tweets that contain certain keywords. For a tweet to be counted towards the measure, it should contain a dual combination. First, it should contain crypto-related keywords like crypto, cryptocurrencies, Bitcoin, or Ethereum. At the same time, it needs to contain some ideology keywords. And to locate ideological related keywords, I collect 20 million tweets posted by 29,000 crypto influencers, followed by more than 20,000 followers. Now, I asked GPT-4 to screen for ideology tweets that convey certain ideological emotions or messages, and then return the keywords that lead to its judgment. And here is the results returned by GPT-4. So for anarchism, it contains a dual combination of first, the name of an entity, government, central bank, Fed, authority, etc. and also some emotionally charged word like control, threat, freedom, trust. And to get a sense of what these keywords will, the twist located by such keyword look like, here is some examples. For example, this one saying, Bitcoin is not a bubble. Government control of money has caused distortions and true bubbles. And also this one says, here is what you can do against the corrupt system. Use crypto, be your own bank with crypto, and never trust the government. And for the decentralization ideology, the keywords are much more simpler. It's just decentralized, decentralization, etc. And here's an example saying decentralization is the way, hashtag crypto, hashtag liberty. And this is another example is a DeFi platform that uses hashtag decentralization as a marketing buzzword to attract people to its platform. And when we look at the summary statistics, we can see that the association between the two measures is 0.4. And when we look at the past 3-day innovations, which will be used in our empirical test, is just 0.3. So it suggests that the two measures are capturing distinct aspects in social media about narratives. So the data on cryptocurrency pricing is from coinmarketcap.com, which is a popular data source for crypto pricing data. And following previous studies for cryptocurrencies to be included in the sample, it need to have non-missing pricing data and also market cap over $1 million. No stable coins are included in the sample because their prices are artificially maintained at a stable level. And additionally, I require a weekly trading volume to be over $1,000 to filter out some suspicious price movements and data. For example, here is a coin named Innovative Bio Research Classic. In the first week, when its market cap went over $1 million from 0.85 million to 4.71 million, its total weekly trading volume is just $230.50. So the number fails to add up. And adding this requirement, which is quite minimal, but helps fill out such suspicious price movements. So now let's talk about the empirical test. The first test in the line is a sorting test. The key idea here is that the return code movements with innovations in the ideology measures proxy for risk exposures if the ideological narratives really are associated with some systematic movements. For the innovations in ideology measures, it's just the number of ideology tweets today minus the past 33-day average, because it's the innovation part, that the unexpected change part, that matters for how people form their expectations. Is there a question? Oh, sorry, it's Andrews message. Okay, good.
So it was just me.
Good. So, yeah, so the key idea is that the rhetorical movements with such innovations in ideology measures proxy for risk exposures. And if the ideological narratives are associated with some systematic risks, then the exposure to it should line up with the risk premiums, the classic return proportional to the beta model. And to do this, at the beginning of each week, I calculate the past 30-day return code movements of each cryptocurrencies in the sample with the ideology salience. And then I sort cryptos into the equal-weighted quintile portfolios. And here is the result. So when we go from the bottom to the top quintile, it has a nice monotonic pattern. The more a cryptocurrency can move with the ideology salience, the lower expected returns it earns. And we can see that there is a significant negative spread between the top and bottom quintile portfolios. And the negative risk premium suggests that investors may attach higher value to cryptocurrencies that co-move more with the ideological values, and therefore leading to greater valuations and lower expected returns. And to formally test the price of risks, the risk premium of the two ideological narratives, let's construct the ideology factors using the traditional empirical asset pricing approach. So at the beginning of each week, like before, I calculate the return movements of each cryptocurrencies with the innovations in ideological narratives over the past 30 days. And then I look at the cross-sectional distribution of the covariances, normalize it to the minus 0.5 and 0.5 interval. The normalization is just to get the portfolio weights under control because the movements, the size can go quite large. And I map them reversely just because we observe a negative risk premium before and to have a positive factor premium here. And I construct the factor portfolio with weights proportional to the normalized covariances and track the portfolio return over the week. And that's the factor portfolio we're looking at. So because the two ideological factors, they are tradable portfolios, so the time series average provide an estimate for the factor risk premiums. For anarchism, we have a 4.96% weekly risk premium, and also for the decentralization, we have 3.17% weekly average returns. Both are pretty large in magnitude. And they are significant at 1% level. The numbers in the parentheses are the t statistics. Because when we construct the factors, we don't control exposures to other things. So it may lead to the question whether the large risk premiums we observe here actually because of correlations with some other factors or some latent factors we don't control for. So to formally test the price of risk of the two ideology factors, I use the two-stage Fama and Macbeth approach. It's a pretty simple test. It has two stages. In the first stage, we estimate betas. Betas here represents the risk exposures. We estimate betas with time series regressions of each test asset's excess returns on the proposed factors and get the beta estimates. I'm using a rolling window estimate of past 2 years, that's 104 weeks, to estimate betas to allow it to be time varying because there's no reason to believe the risk exposure is constant over time. And then in the second stage, we ran a period by period cross-sectional regressions of excess returns on betas. And the variables of the parameters of interest is lambda, which provides an estimate of the price of risk for the ideology factors. Others we can include either including intercept or without intercept. There's no solid reason to choose one, so I ran both. Here is the result. We can see that the coefficients show us that for both anarchism and decentralization factors, they carry significant risk premiums. After controlling for exposures to pre-existing factors like crypto market, size, and momentum. And the magnitude is even larger than the simple time series average. The data is at weekly basis, so this is still weekly risk returns. And when we look at the test with the intercept, it has a similar conclusion. And it's worth noting that here, when we look at the constant, the intercept, it captures the pricing errors. We can see neither of the models here either is just ideology factors or the three factors of market size and momentum, or we include all the five factors. They all have some pricing errors remain, so neither of the models here can explain the cross-section of the test assets completely. And the test assets I use here is size and momentum sorted portfolios.
So can I interrupt you for a few minutes, for a few seconds,
Mm.
for a few questions? So we have a question in the Q&A which asks whether or not you control for institutional adoption. And maybe I can actually expand that question just a slight bit. In some sense, the methodology that you use is one where there's a certain degree of stableness in the market assumed, right? So that, over long stretches of time, the market is what it is. Whereas in the time series and in the time horizon that you study, there's a lot of new crypto assets enter the market. There's a lot of new viewpoints and new investors that enter the market. As Daniel here says, there's institutional adoption. There was a difference between who was interested in 2010 to who was interested in 2020. So that's part of, what the investor base is one part. And then there's a second question that actually relates also to the view of anarchism and decentralization for the assets. That should be a constant feature. I mean, sometimes there are changes in assets over time or the underlying mechanism over time, but in principle, these should be, it's like a constant, right? It's just an attribute. So, whereas, if you use data on anarchism versus and from Twitter, this is a time series data with time variation. So is this how do these things come together for you?
Yeah, great question. So first, for the first question, the time exposures to institutional holdings, I can definitely look into that. I haven't done any test that in controlling for the exposures to institutional holdings, and I definitely agree that the crypto market is evolving over time. There's a time series variation in the investor base and also in the market structure, as we see more and more mainstream investors are now becoming increasingly interested in crypto assets. And regarding my results, because my sample spans from 2014 to the January 2023, so that includes partly of like the new stage of crypto market with the more interest from the mainstream. But when I split the sample in half, like for just split the sample in half and check the time series, the price of risk or factor risk premium in the subsamples, I find the ideology factors, the behavior are pretty consistent across different subsamples. So that doesn't, the time varying, like the market dynamic evolving over time doesn't seem to be uh, that a big force behind my story. And also for the second question, like, well, the prior belief, ex ante, you may expect cryptocurrencies, their attributes about like how much they are related to the ideological narratives are constant or quite persistent features. Yeah, I had that doubt as well. So it kind of surprising to me as well why we see such strong ideological factors based on their risk premium. And also, if the features are like constant over time, we don't observe really a time variation in the factor return. So we wouldn't observe that. And this is also relates to what my paper is about in the next stage is to investigate why some coins can move more with the ideological narratives and some can move less. I do have some findings about that. For example, for the anarchism ideology, I find cryptos that can move more with the anarchism narratives, they have more active developing team behind based on the GitHub commits numbers. And also they have more trading blocks created per day. And for decentralization ideology, it tends to have more higher hash rate, and also they tend to be labeled as governance tokens. Because I'm looking at, so regarding the measures, I'm looking at past the 30-day return call movements. There is turnovers in my portfolio, so it's not consistent over time. But that also poses some like puzzles or question I need to address, like why there is a migration across different cryptocurrencies. And perhaps partly because the ideological narratives I'm looking at here is different from ideological preferences like held by investors, which is quite persistent over time and doesn't change much. But for ideological narratives, like how loud this ideological messaging is in the crowd, is likely to be time varying. And I think people who talk about it don't necessarily hold such, they are don't necessarily mean they are true believers. So that's a subtle difference. I'd like to make it clear here. But yeah,
So,
you are a
so
great
maybe I
question.
can. There's also a question. The first question from Narajan, or Nirajan, seems to be a question which is a clarifying question. So maybe you could just clarify this one more time, which is so he basically asks, quantifying decentralization using text-based data is unclear. So his argument, I think, as I read it, if I condense it, is
Mhm.
decentralization is a feature, it's not an opinion. But I think what you're saying is the emphasis and the discussion points are being put forward, right? Is that correct?
So the decentralization narrative I'm capturing here is really how loud, like how much people are talking about it. And people who talk about decentralization don't necessarily understand what is decentralization exactly and what kind of technology it needs to realize such decentralized feature. So I think that's the key difference between like narratives, popular narratives that allow everyday people to participate and engage, maybe even foster their identities around it. And it is quite different from like what a cryptocurrency really is about, how much decentralized it has in its attribute and in its fundamentals.
So there's a there's another question by Daniel. It's also a clarifying question, which asks, so you try to quantify strength of ideology similar to a sentiment analysis, or is it just the occurrence of observations of mentioning of decentralization?
Yeah, so from the measurement itself, it reflects the frequency of how many times such decentralization tweets posted per day. And for
Um,
sentiment, that's a good point. I also have tests showing neither crypto sentiment or attention drives the results.
and then there's a question about the narrative factors.
Mhm.
So do you have, is it very specific to the specific mentioning, or could this be general tech hype that was something that we saw generally in, let's say, 2020? So how did you decide that you're looking for these specific ones? Were there other ones that you considered?
So mainly, I'm interested in how ideological narratives affect asset prices. And when I look at crypto space, it's kind of obvious why I'm going through various anecdotal evidence saying there's a close association between crypto and libertarianism. And when I look at libertarianism, there are two primary aspects. So that's why I choose these two ideological narratives to focus on, rather than just cherry pick some popular or some most salient narrative that seem to drive the result or returns.
Yeah. We have one more question in the Q&A, which I'm going to punt to the Q&A. So sorry, I wanted to have just a few more clarifications here. I'm going to let you continue at this point.
Oh,
Thank you.
thank you. Yeah, great questions. So next is let's look at how pricing what's the pricing performance of the ideology factors. And in the literature is quite a common practice to use the time series test when we compare different factor models. We just run the time series regressions for untested assets of excess returns on the proposed factors, and the intercept alpha captures the pricing errors. And here's the result when I compare the ideology factors against a benchmark model of three-factor crypto market size and momentum proposed in Liao and Wu 2022. And the first so each column corresponds to a different pricing performance measure, and the first four columns, they're just based on alphas, like different versions of alpha related measurements. For example, root mean squared alphas or average absolute value of alphas or about the t statistics of the alphas. The smaller the value is, it shows a smaller pricing error and therefore better pricing performance. And we can see that ideology factors have smaller pricing errors across two panels. In the first panel, we have a set of 8 test assets, its size and momentum based long-short portfolios. And in the panel B, I expand the set of test assets to include to give it more test power. It includes all size and momentum, single sorted and double sorted portfolios. But in both panels, it shows ideology factors have smaller pricing errors and better pricing performance. And also, when we look at the maximum Sharpe ratios spanned by the factors, the ideology factors have higher Sharpe ratios, which means it's closer to the mean efficient frontier. And here comes the robustness check when we look at why, if the biggest concern of confounding factors like crypto attention or sentiment drive the result of the narrative ideology narratives. So to see this, I measure the crypto attention by the number of crypto tweets posted on X on a daily basis, and for crypto sentiment, it's measured by the difference between the frequency of positive lexicons net of negative lexicons. And to get the list of sentiment lexicons, I trained a large language model, Roberta, to classify tweets for such sentiment analysis. And then I look at the results and calculate the sentiment weights for each word tokens. So the sentiment weight is also based on the difference between how many times a word token appears in positive tweets versus its appearance in the negative tweets. And when I sort word tokens based on their sentiment weights, I take the top and bottom decile group to form the sentiment lexicon. And the resulted sentiment measure has a correlation of 88% with a NLP-based sentiment index issued by this company, who is specialized in all kind of sentiment index or other indexes. I don't use their index data directly because their sample just go back to 2017 and my sample starts at 2014. And here is the result. When I sort cryptos by their return exposures to crypto sentiment or attention, there is no monotonic pattern in the quintile portfolios, meaning the exposure to it doesn't line up with their risk premium. And also there's no significant spread between the top and bottom quintile. And for the test of price of risk, when I include them as controlling for exposures to crypto sentimental attention, the estimated price of risk for the anarchism and decentralization factor are still pretty significant and large in magnitude. And here, next, I'm looking at how much predictability the ideology factors have for future crypto market return. The point is to see how to interpret such ideology factors, whether they're just some like short-term mispricing or some noise that accidentally capture the cross-sectional variation in crypto average returns. So I do this test. If they can predict the future crypto market return, that shows they contain important information about crypto market. And here we can see that both anarchism ideology factor and also decentralization, they can predict future crypto market from 1 week up to 6 months ahead. The shadow area The shadow area shows the 95% confidence interval, and the result is robust to controlling for crypto market return, crypto attention, or crypto sentiment. The third panel is the mean variance efficient portfolio spanned by the two ideology factors. The thing about this panel is that there's a theoretical restriction on what the size should be when we predict future crypto market return with a mean variance efficient portfolio. It should be positive, and we can see that it's consistent with the theoretical prediction. And also the other variable I look at when I test whether the ideology factors are associated with the future investment opportunity set in the crypto space is the network growth. I look at both Bitcoin and Ethereum. That is motivated by the theoretical works on cryptocurrencies. Theories usually model the value of cryptocurrencies to be the transactional benefits they provide when they work as a when they function as a currency on some DeFi platform. So usually there is a network effect. The larger the network, the higher the transactional benefits it expects to provide in the future. So that's why I look at the network growth. I'm using the number of users' wallet to measure the network size. And when we look at the Bitcoin network growth, it's interesting to see there is a difference between the two narratives. First is anarchism. It has it can predict future Bitcoin network growth from 1 week up to 4 weeks ahead. But for decentralization narrative, we don't observe anything. However, when we move to the Ethereum network, the picture changed. The picture changed. So the decentralization narrative can predict future Ethereum network growth from 1 week up to 6 months ahead. So for example, for one standard deviation increase in the decentralization factor return, it's associated with about 8% increase in the Ethereum network growth. So that's a bit, I find it's quite interesting and also intuitive result when we look at different network and how they are related to different narratives. Because I think the Ethereum the Ethereum community isn't that vocal about anarchism, about how they distrust or don't like government control, but they are more vocal about the decentralization ideology. And the final study is an event study that shows what happens when there is unexpected increase in the ideology salience. So when the attention to ideological narratives get heightened unexpectedly, this collective beliefs or values get reinforced, we may observe a relative increase in demand for more ideology-aligned cryptos because investors may now assign more values to assets that are more aligned with their ideological values. And therefore, we observe a positive spread between the top and bottom quintile cryptos when we sort by their co-movements. And it's consistent with what we see in the two event studies where I collect a series of events that may stimulate the ideology salience. And we can see that on event date, when this happens, there is a positive spread between more ideology aligned, that is, can move more with the ideology narratives versus less aligned ones. And I think I'm running out of time. Let's conclude. So my paper provides novel quantitative evidence on how ideological narratives can play a central role in asset pricing as a source of systematic risk, using cryptocurrencies as a natural laboratory. And a ideology factor model can explain the crypto average returns better than pre-existing factors. Thank you so much.
Well, thank you so much for the insights. We have very little time left. We have just time for one question. And I think here, this is where I want to very briefly get to the question in the Q&A by MTS. And essentially, he or she asks whether or not what do you think is the theoretical justification for the particular returns, right? So what's the intuition behind the systematic compensation it required to exposure to the ideologies?
Yeah, great question. So I don't have a formal model for that, but only a story. So my story for that is when the crypto market is down, cryptos have that are more aligned with the ideological values are less subject to sell-off, comparing to cryptos that are less aligned with the ideological values or popular ideological narratives. And therefore, those less aligned ones that come off less with the ideological narratives, they will have bad performance, worse performance in the downtimes. And therefore, asking for compensations for investors to hold them. And we observe a real or expected returns for more aligned ones and high expected returns for less aligned ones. So that's my little story for that.
Okay, thank you so much. Thanks, Jian.
You.
We move on now to our second speaker, Gordon Liao, or Gan Lao, who has an illustrious career. He worked for the Fed in the US, also for Uniswap, and is now the chief economist. Is that the right way to chief of research at Circle?
Head of research
Um,
and economist.
Head of research. There you go.
Do a bit of
And
engineering when I can.
Gordon, we're very happy to have you here. The floor is yours.
Thanks so much for inviting me, and thanks so much for including this paper. Really excited to discuss this paper, which we released last year, but since then we updated the data a bit, especially including the more recent periods. And I think this touches some of the elements that Jiaen was mentioning in the last answer regarding maybe the narrative component, which type of crypto actually have potentially performance that's outperforming general risk market. So let me get started right away. So the basic research question is very simple. What drives crypto asset prices? And there are many ways to look at this question, right? We could do the traditional factor-based asset pricing. We could think about the more macro implications. Here in this paper, we really focused on cryptocurrencies as an asset class, and we're really focused on specifically Bitcoin prices. We could probably extend this later on by looking into all the other altcoins, but here mainly it's about Bitcoin prices. And then we asked a very simple question of, are crypto prices driven by more fundamental shocks in the same way as traditional financial markets? And to what extent do you have spillovers of shocks, traditional shocks? For instance, just general risk-off sentiments or monetary shocks into the crypto space, and how much of the crypto returns are more independent and idiosyncratic to those general shocks. And I think understanding that's quite important from just a broader understanding of what are the macro drivers of crypto, but also from an investor specific angle of is crypto asset class a asset class that could stand on its own, have its own independent correlations and independent shocks in which it's more of an asset class rather than it's just a highly levered beta play on say risk assets. And so let me just jump into how we do this. So we do this by applying a very standard structure restricted vector autoregression with some amount of magnitude restriction as well. So this type of model has traditionally been applied in macro literature for estimating more longer term time series of say things like unemployment or things like inflation. This is the stuff that I used to do at the Fed, right? Run a structural VAR model and try to predict where the inflation would be in the next couple of months. The application in finance has been picking up, academic finance at least has been picking up in the last couple of years. And there are some literature out there that's trying to do a higher frequency version of this for traditional asset classes. So today we're looking at um, essentially Bitcoin return and decomposing Bitcoin return into primarily three different shocks. One is monetary policy shocks, represented by 2-year Treasury note yields, conventional risk premium shocks, which are represented essentially the factor extracted from S&P 500, and then more Bitcoin specific demand shock. Note that these are shocks that were not directly extracting from the price returns of risky assets or bonds, rather is the transformed version of it. And I'll go into what that means in a little bit. But basically, we're decomposing the daily innovation in these asset prices into more orthogonal sources of shocks rather than ones that are that could be correlated. So, and then in addition, we do this extension in which we further decompose this Bitcoin specific demand shock into both the crypto growth component, or crypto demand component, and the crypto risk premium component of it using stablecoin flows. So what are the main findings? I would say I'll show you a graph and then I'll kind of walk through these. One is just traditional shocks do impact Bitcoin prices and crypto prices. And that might seem obvious, but if you actually read some of these anarchist type of narratives, sometimes people say, "Oh, the Bitcoin is not related to traditional asset classes." So there are definitely sentiments, especially in the crypto sector, that feels like, oh, this is not related to the broader economy and this is pretty isolated. So we actually do find that much of the decline, at least early in the last couple of years early on, in the early part of the 2020s, are driven in large part by either flight to safety type of shocks or monetary policy shocks. But then later on in the time series, in the last 2-3 years, there has been a lot more idiosyncratic crypto demand shocks. So in addition, on the other hand, there's also people who would just say, well, Bitcoin and crypto are just kind of like a levered NASDAQ play. It's just a risky asset. It's just more levered up in some way. So that's actually not true either. There are also very specific crypto demand shocks. So I'll talk about those in a little bit. And then when we extend the model using stablecoin flow, then we can kind of separate out this crypto demand shock into risk premium versus adoption. And then lastly, I'll talk about a few specific event studies. But let me just jump into like one overall time series of how we end up decomposing these returns. So in this graph, the black line is the cumulative log return for Bitcoin. And that's the overall return across those years. So it has a log return of around 3 since 2019. And this log return, overall cumulative log return, could be decomposed into several components. So if you add up the blue, red, and purple line, it adds up to the black line. So what are these different components? One very large component is crypto-specific demand. That is the blue line. So certainly that has driven probably about half of the overall return over this sample period. But equally important, I would point out there is quite a bit of return that were driven by conventional monetary policy. This is extracted from the 2-year notes yield time series, as well as just general conventional risk premium from the risk market. So in some periods, for instance, if you look at the period between early part of 2020 and 2022 and some of the rebound in 23, there's actually more of the larger price movements coming from just conventional risk, conventional monetary policy shocks, and conventional risk premium that's driving Bitcoin return than crypto specific return. And then in the last 2 years or so, with not just last 2 years, but there are several events that have also driven quite a bit of crypto's specific demand and returns. So the BlackRock filing of the ETF, it really did boost crypto specific return. The 2024 election, even though it boosted equity market initially, as well as crypto market, the crypto market benefited a lot more from it. So it's actually tagged as a crypto demand shock. And now going to the more recent, updated the time series just last night, so we can look at the more recent tariff events. And there again, it's actually striking that even though the crypto market overall is lower, but the crypto demand shock is actually positive. And even though the risk premium and the monetary policy in this case are driving down the crypto risk or crypto returns. So let me jump into the more interesting part of the methodology. So how do we identify structural shocks overall, right? So this is a common question that macro econometricians face. So one approach is take a narrative approach, really study, during which period, what type of what type of shocks are coming from. For instance, budgetary reasons versus tax reasons. This is the early rumor study. I think looking at some of the congressional filings and really text-based narrative to identify shocks. Another approach is a high-frequency identification. So that's the Nakamura-Stenson type of approach, using these high-frequency around FOMC event windows to identify monetary policy shocks, looking at the future price changes. Our approach is based on asset price correlation. The simple way of looking at it is like on a given day, if equity goes up, equity goes down, yield goes up. Then we can infer potentially a positive monetary policy shock. But if both, equity goes down but yield goes down as well, then maybe it's a different type of shock. So it does require certain assumptions, and I'll go over the assumptions in a little bit. But if you look at it, the assumptions later, it makes a lot of sense, at least intuitively. And the whole idea is you back out the structure shocks away from just the asset price movements. So this SEN-restricted VAR model also have a long history, but more recent. It started with ULAG in 2005. The specific application in finance, CISLAC and Penn in their paper in 2022 started to adopt this for financial assets more specifically.
Maybe I can just quickly interrupt you because there was a clarifying question that would be useful to ask here by Gabriella. So she asked, could I please check how the structural shocks were identified, whether based on simultaneous structural breaks or a Bayesian parent structural break test or something else? Maybe just can clarify this one more time.
Yeah, I think so. The structure shocks are basically identified. Maybe the next two slides will help based on transforming the reduced form VAR into a structural VAR. And how do I make that transformation is by making a set of sign restriction assumptions, as well as some magnitude type of restrictions. So you had to believe in the assumptions, and I'll show you assumptions, I think, next. But the general idea is, you start with a reduced form VAR, and reduced form VAR is just relating the, in this case, equity yield and Bitcoin return in a very reduced form way. But then to get to the structure model, you basically had to transform the shocks, right? So you had to be, so one thing is it implies that there's linearity in how the structure shocks, which is the epsilons, are related to the non-structure reduced form errors. That's the E. So the structure shocks are a linear combination of the reduced form shocks. So that's one assumption of linearity. But then we basically also do certain restrictions that also transform the model. So any particular asset pricing model does imply a specific matrix that transform the two different shocks. And to get to this singular, essentially transformation matrix, we had to impose certain sign restrictions. So let me just go into some of the sign restrictions and see if it makes sense to the folks here. One is the monetary policy shock. We assume that if there's a positive monetary policy shock in which it raises the yield, so think of it as monetary policy tightening, what naturally happens is stock market goes down lower, Bitcoin price is also goes down lower through a discount rate effect through risk-free rate. So this is intuitive, but we're just assuming that is the case. So we're building into that structure model. And then another sign restriction is conventional risk premium restriction, in which if there's a risk premium shocks, so risk premium becomes higher, generally that means the risk off, that generally lowers the yield, that generally impacts the stock price and Bitcoin price negatively as well, right? So that's a flight to safety risk off type of risk premium shock. Note that it's a bit different than the sign restrictions on the monetary policy shock, because in the monetary policy shock, the yield increases, whereas the risk premium shock, the yield decreases. And then crypto-specific shock, basically, we're just assuming this sort of shock only affect Bitcoin price, and its impact on equity and yield are undetermined. But then we can manage the magnitude through, we can impose certain magnitude restrictions. So how would that look like in terms of like a matrix of restrictions? So we have conventional risk premium affecting Bitcoin return, yield, and S&P 500 return negatively. We had a monetary policy shock that's affecting Bitcoin return negatively, but positively on the ZCB is a zero coupon bond yield positively, and S&P return negatively. And then crypto demand there's two undetermined directionalities. But it does impact Bitcoin return positively because of the crypto demand. And then we know that, basically by assumption, we're assuming the spillover from crypto market to traditional financial market is not very meaningful. So that's a magnitude restriction that we impose, which is probably true at this point still, that crypto market overall doesn't affect traditional financial market. We don't impose a magnitude restriction in the other direction, that is traditional financial market still could impact crypto market. So implementation of how we do this is, first we estimate the reduced form shocks, the errors using OS. And then we basically use an algorithm to generate possible combinations of this transformation matrix between the structural shocks and the reduced form shocks. So it's a very large seeding algorithm in which we basically randomize and seed a bunch of values, and then we only keep the combination in which the impulse response satisfy the sign and magnitude restriction from the prior slide. Right? This is actually, I think, a methodology developed by some of the prior work. And then we implement step 2 with a Cholesky decomposition, and then we simulate a large number of rotation matrices following this prior work. So after all of that, we retain only the shocks that are consistent with the sign restriction, as I mentioned. But still, there are many shocks that could be consistent with the sign restrictions. So what do we do? So one of the earlier work basically showed that the median target solution is a pretty good solution to the overall transformation. So we show that, and we also share. So this is so between the two different gray bands, that's all the possible solutions that we could generate that still satisfy the sign restriction and magnitude restriction. And then the purple line is just the median target solution. So it kind of shows that the median target solution falls within the band, but also the band is not terribly large. It is large in some cases, but it's directionally still relevant. So even if median target is not the right approach, maybe it's an average target or something, it's still roughly correct. So these are the normalized shocks over time. So this is the structure shock that we can extract from the non-structure shocks. How am I doing on time? I have some time.
So you should have another 10 minutes for your presentation.
Okay, yeah, that's great. Yeah, feel free to ask any additional questions. So with this, we could really decompose not only equity and bond return into different categories, but we could also decompose Bitcoin return. So this is just a different graph of what I showed earlier, but year by year. And you can see that there are distinct periods of time in which one of the factors dominates over others. So in 2022, it was actually crypto demand that dominated, even though monetary policy was accommodative at the time as well. Um, in 2022, which is a year in which there was a lot of crypto volatility with the failure of Terra and Luna and the failure of FTX, so we would have expected a lot of the negative returns in the crypto sector coming from crypto demand lacking. But in fact, it was actually monetary policy being a larger driver during that year, more so than the crypto specific factors such as FTX failure. So that was quite novel to us. And conventional risk factor was actually positive. So it was actually a positive driver. 23, it was kind of the reverse. It was both monetary policy and crypto demand was positive. Crypto demand probably is a bit more positive. Maybe that's from the beginning of this crypto bull cycle with the BlackRock ETF. 24, I think this data was not fully updated, so it's partial data from 24. So ignore the 24 year. So we could also do validity checks by looking at what what this model tells us about the decomposition of S&P 500 and 2-year yield return. And by and large, it's aligned with our intuition. So monetary policy shock really had a huge effect on boosting stock prices up until monetary policy basically turned, tightening happened in 22. And then since then, it's sort of flattish from monetary policy perspective. But conventional risk premium just continues to go up. Again, this graph is not updated, but more recent, I'll show you the tariff stuff in a little bit. And then decomposition into the 2-year yields, it's also, it's mostly driven by monetary policy, but the conventional risk factor does matter as well. So note that we use a 2-year yield instead of something like Fed fund rate because the 2-year yield does embed a bit more of the conventional risk premium in there, in that if there is a risk-off type of demand, there's a flight to safety to the 2-year, as well as other longer maturity bonds that's above and beyond just expected monetary policy movement. So we could also look at the variance decomposition as another check, another robustness check. And largely it's aligned with what we think should happen, which is, well, the 2-year bond has roughly equal variance being explained by monetary policy and conventional risk. S&P 500 actually, it's a lot of it's driven by monetary policy. This is actually not quite surprising to me, have worked at the Fed and also have traded in the traditional space, finance space. So much of the market actions are driven by the Fed. But what's really interesting is the Bitcoin return. So much of it is just driven by idiosyncratic Bitcoin demand, at least on a day-to-day level. Even though on the trend level, on the lower frequency level, you see monetary policy playing a very important role, but on the day-to-day level, there's a lot of idiosyncrasies of crypto demand. So model extension we did was also, well, can we break down this crypto demand into different components? Well, one way to break this down is by introducing another asset. If we introduce another asset, so we have four assets, we can get to four different structural shocks. So what is this asset? Basically, we introduce stablecoin flow. That is changes in stablecoin circulation adjusted by the fluctuation in stablecoin price. Even though stablecoins are pegged to one, there's a market price in the secondary market that sort of amplifies the daily changes in the circulation. So we make an additional assumption that if there is both increasing stablecoin circulation, stablecoin flow is positive, and there is increase in Bitcoin return, then that's more of a crypto adoption type of shock. But if it's a increase in stablecoin circulation, but returns on Bitcoin is negative, is more like a crypto specific risk off scenario. So there is a negative shock there's we call it crypto risk premium. So it's positive on the stablecoin flow and negative on the return. So with this, we can extract the shocks into four different shocks. So we basically break down the crypto demand into crypto adoption and risk premium. And what that gave us is even more granularities into the different drivers of Bitcoin and stablecoin. So on the Bitcoin side, you have previously just one single crypto demand shock, but now it's broken down into a crypto adoption. According to this graph, the adoption, at least until 2024, has been more of the drag than the increase. But you do have a persistent increase in the crypto risk premium element of it. So this is from 2022, 2024. I should extend this to the more recent day to see what happens. On the stablecoin side, we could equally look at how do we explain stablecoin circulation increase into different components. And there is also a distinct crypto adoption, just usage of crypto overall, hasn't materially changed over at least this period of time from 22 to 24. But you have meaningful change in monetary policy during this during this period of time. You have meaningful change in also conventional risk factors that actually boosted stablecoin circulation. So lastly, I'll go over a couple of different event studies. One is the FTX turmoil in around November of 22. That was so FTX went under, it dragged the entire crypto market down. And if you actually look at the event study of what was the drag and where was the drag coming from, it was very clearly the drag on both crypto risk, but even more so, it hurt crypto adoption because I think at the time there was just people stopped really using crypto, especially those who were experimenting, and there was a lack of adoption at the time. Similarly, on stablecoin flow side, so much of the change in circulation around that time was showing there was a lack of stablecoin adoption being the primary driver. And then let me move to the more recent time period now so this is extending the data to just the last couple of weeks. And this is going back to the baseline model with three different components. What we can see is there is more recently, Bitcoin return has been slightly down, somewhat down actually. But so there's a negative sentiment in the crypto market. But in fact, if you actually break down the composition of where that return decline came from, it primarily came from conventional risk premium and conventional monetary policy. Recall that conventional monetary policy is reflecting somewhat of this 2-year yield. given the Fed have stated pretty clearly that they don't want to lower interest rate just because there is market turmoil. They care more about inflation. And that's probably a bit of a drag, along with just lack of treasury demand more recently. But the crypto demand actually is positive. I think this is to the narrative of maybe the crypto anarchy narrative of this is digital gold. And so even though the overall return has been down um, for Bitcoin in this time period, the um, the crypto specific demand part of that return is actually positive, that people actually demand Bitcoin for its store value reasons. The drag on the return is mainly coming from the conventional risk factors. Yeah, so let me just conclude that we estimated a structure, sun restricted VAR to study the daily return drivers of Bitcoin and also stablecoin flow. And we find significant low frequency spillovers from traditional financial market into crypto asset space. But much of the variabilities of daily Bitcoin price are left unexplained by traditional shocks.
All right, thank you so much, Gordon. That was very insightful. I have two questions in the Q&A. Let's go from bottom to top as I see them here, maybe. Um, let's start with a general question that probably gives you another chance, and also just to summarize, because obviously this is what you've been talking about. But if you could maybe expand a little bit on the factors, sort of like maybe not so much in terms of the measures that you use, but the broader picture of what actually has driven the Bitcoin returns that we've seen over the last decade or so.
Yeah, so let me go back to that earlier slide. I think it's if I could summarize it in one sentence, I'd probably say that early part of uh, it's actually quite nuanced, right? I would say a large part of Bitcoin return, probably half of it, are driven just by conventional monetary policy and risk factors. That over the last, I don't know, at least in this data, 6 years or so, there's been overall accommodative monetary policy. Overall, it's been a risk-on environment that helps out risk asset. But there has been increasingly more idiosyncratic crypto demand that's coming from either crypto adoption or crypto specific risk premium. So that's a new development. And as an asset class, Bitcoin is starting to have its own movements that's quite independent of traditional markets and serving its unique role in having its own return structure.
So I mean, it's quite clear from the data that monetary policy seems to play a role in the Bitcoin returns, but I'm just struggling with the idea of how this, works in practice, other than if we just think about the prices. Like what is it? What is really the connection between monetary policy and Bitcoin, right? So how do I think about that?
Well,
So
yeah.
you know
So
what I mean? So it's like something, there's something tangible, something has to happen in the usage of it or the like.
yeah, I didn't go through too much of the narrative component, but the narrative component that crypto folks usually say is, well, you have looser monetary policy that leads to inflationary outcomes, and Bitcoin is supposed to be a store of value. Therefore, with inflationary outcomes and looser monetary policy, that generally would boost Bitcoin return. So I think that explains this, component from 2020 to 2022. That was a low interest rate period, ease of monetary policy, and that actually boosted Bitcoin return quite a bit. And then when there was tighter monetary policy, that was a drag on the Bitcoin return. Um, so it's
But
more
can you, I
related
mean, so
to,
if you think about it, I mean, you can, I think the case, you can make that case, like when we're talking about percent or basis point movements, but Bitcoin has been, just since 2018, 2017, has gone from $500 to almost $100,000. So that's massive returns, right? Can this all, I mean, I can understand this narrative of, I mean, we've heard this a lot obviously we've all heard it, right? So that Bitcoin is gold and monetary policy is too loose and we're going to lose our shirt and all, but the magnitude.
Oh yeah, the magnitude is not large, right? That's overall, that's, if from a log return perspective, so monetary policy probably only explains, less than a third, maybe 1/6 of the overall
Right.
return. So it's not large, but it is there. It's a component that became more salient during certain period of time. And it does explain some part of the return growth, but it doesn't explain that much of it. It's maybe less than a third. So that's and then the major driver is still this crypto demand. Now, what is crypto demand? Well, you could say it's idiosyncratic demand for crypto, but I think part of it is also just capturing like the fact that it's an adoption that hasn't even just as a digital gold, it has to take time to be adopted. It doesn't get adopted right away.
I mean, there's a few people. I mean, there's a lot of, if you think of US investors, it's it's a big base, but it's a limited one, right? Whereas Bitcoin is a worldwide asset where, if here and there people just buy $100 of it, that adds up to some real money quite quick, right? So that's kind of the adoption narrative there, right?
Yeah.
Now I have a few clarifying questions here in the Q&A that I probably want to go through. So Christina asked just a very simple question of what was the meaning of low frequency in your data, just to clarify.
What was the meaning? Low frequency meaning if you look at the high frequency here is defined as daily. So low frequency is more of this trend line, right? So these are, I don't know, multiple months or multiple years. That's kind of a low frequency. The higher frequency here is not super high frequency, it's just daily.
So then I have a question by David who asks essentially about co-integration tests. I'm not exactly sure what he seems to have something deeper probably in mind, but he asks if you did any co-integration tests, granger causality tests on the VAR models.
Yeah, so the idea of these identification using SAM restriction is effectively assuming that the SAM restriction is true, um, then you could extract the more structural elements, more say causal elements from these different shocks. So it's almost, Granger causality and co-integration, especially Granger causality, is not really causality, right? It's just what's the lead and lag effect of things. Here, we're actually saying, well, if you assume that these SAM restrictions are true, which is a big assumption, but we can argue about whether these assumptions are true, then by that assumption, you automatically get causality.
Okay. Now then we have one more question. The Q&A is from Michael, who essentially asked questions about identification, the identifying assumptions for your thesis, for your analysis here. So and the validity thereof, which often in asset pricing, I don't think. I mean, it's nice to have, but not really done often. But maybe you have some thoughts on that.
Yeah, so again, I think this is a literature that many people have poked holes in it, but many people also like, well, there's not much better. It's time series analysis. You don't have the perfect experiment. You don't have cross-section identification. So the most that you could do is, assume certain structures and then compare the validity with intuition with what we expect. So I think the validity check here of S&P 500 and 2-year yield, that is largely matching both the expectation and also prior literature. So that gave us some comfort. Now, is this perfect? No, but is this better than nothing? We think it's better than nothing. Similar with variance decomposition. Does the variance decomposition make sense? Yeah, it sort of makes sense. But there's no hard check of this is absolutely valid assumption, but it's more of you had to assume something to get to causality. If you don't assume anything, it's just time series.
Okay, very good. I don't see any more questions in the Q&A unless somebody has a question quickly and wants to enter this. I see nothing coming. So thank you very much, Gordon, and also Jian for giving us insights here. We're glad to have had you. For the rest of the audience, just a quick note that we have another webinar on May 8th. This one will be very broadly speaking on a specific piece of the Ethereum scaling roadmap. And then we have, of course, our grand conference, which is on June 12th at New York University. This is the annual SIBA, it's our 5th annual SIBA conference. So just for those of you who are not aware, we're almost having our birthday in June as a group, our 5th year birthday. Yeah, with that, thank you so much everybody for coming. Thank you to the speakers, and I hope to see you soon in person.